Welcome to Talk Tickers, your deep dive into the most critical details pulled directly from the earnings calls. Today, we are digging into Oportun Financial, ticker OPRT, and their Q3 2025 results. This gives us a really crucial look into the non-prime lending sector.
It really does, and our goal here is to get past the headlines. Oportun just delivered its fourth straight profitable quarter, which is a huge milestone.
A huge milestone.
But, the story is also tempered by some immediate credit tightening, so we need to dissect that profitability beat, look at the strategic shift they're making, and figure out when management thinks these core credit issues are finally going to stabilize.
Let's start with the financials then, because you're right, the headline numbers were, frankly, outstanding. The company didn't just meet guidance, they pretty much blew past it on almost every metric.
That's exactly right. I mean, if you look at adjusted EPS, they came in at 39.9 cents. The Zacks consensus was expecting, $0.26? So that's a 50% surprise.
50% beat. And a year ago, they were at, 2 cents?
2 cents. So the momentum is clearly there.
And the number that really stands out to me, the one that shows the turnaround potential, is the adjusted return on equity, the ROE, 20%.
Mm-hmm.
That's up from just 1% a year ago. It feels like they're validating that long-term goal of hitting, that 20 to 28% ROE.
It does, but that's also the critical question, isn't it?
Yeah.
Hitting 20% ROE in this sector, non-prime lending, with that much leverage, you have to ask about sustainability if the economy takes a turn.
Exactly.
But the good news is, this quarter at least, they showed they could manage both sides of that equation, the credit losses and the funding costs.
Okay, let's talk about the revenue picture because it needs a little bit of nuance. Total revenue was $239 million. It was ahead of expectations, but it was actually down about 5% year over year. So why the decline if everything is improving?
Yeah, that's just noise from some cleanup they did. Management was really clear that the decline was entirely due to selling their credit card portfolio last year.
Yep.
The crucial number is net revenue, which strips out credit loss provisions. That figure actually soared by 68% year over year to $105 million.
68%. Wow.
And that flows directly to the bottom line. Adjusted EBITDA grew 31% to $41 million. The quality of their earnings is just getting dramatically better.
Okay, so let's unpack how they did it, the operational side. That profitability, like you said, it wasn't an accident. It came from 3 core priorities: improving asset quality, expense discipline, and fixing the capital structure.
Right. And starting with asset quality, they're really focused on the unit economics now. So aggregate originations grew 7% to $512 million, but they kept stressing the term responsible growth. And you can see that in how their portfolio is shifting.
And this, to me, seems like the core de-risking story. The shift to secured loans. Secured personal loans are now 8% of the principal balance, up from 5% a year ago. Why does that 3% swing matter so much?
Oh, it's a complete game changer for their risk profile. Secured personal loans run over 500 basis points lower in loss rates than the unsecured ones.
500 basis points.
Yeah. So just translate that. Every $100 in secured loans is $5 less risky than their old stuff. And on top of that, these STLs deliver roughly twice the revenue per loan. It's the clearest sign they're optimizing for quality, not just growing the balance sheet for the sake of it.
That makes a ton of sense. So let's talk about the credit cleanup timeline, because that feels like the key to this stock.
Yeah.
We got some really important clarity on the loan vintages.
This is probably the single most important detail from the entire call. Management broke the portfolio down into a front book, that's loans made since July 2022, and the back book, which is everything before that.
Okay.
The front book is performing well. It's right near their target net charge-off range of about 9 to 11%.
But the split is the punchline, right?
Absolutely. The back book, the old stuff, it now makes up only 2% of the total portfolio balance.
Just 2%.
But, and this is the crazy part, it accounts for a staggering 97% of the gross charge-offs.
Wow.
Think of it like this. The back book is the last 2% of moldy drywall you have to rip out of a house. It's tiny, but it's causing almost all of your current problems. That 97-2 split, it gives you a definitive timeline for when the major credit stress ends, as those old loans just roll off the books.
Right. So, switching gears to efficiency, the expense discipline was also pretty impressive. GAAP operating expenses were $91 million, which is down 11% year over year.
Mm-hmm. And their adjusted OPEX ratio improved to a record 12.6%. They're basically already at their long-term target of 12.5. They are running a very lean operation.
And that allowed them to cut full-year guidance on expenses, right?
Yep. They cut the full-year GAAP OPEX guidance by another $10 million, reflecting savings just across the board, G&A, marketing, tech. This cost focus is what helps them sustain that high ROE we were talking about earlier.
Okay, so third priority, capital structure. De-risking the balance sheet is obviously crucial right now. Their debt-to-equity leverage is down to 7.1x from a peak of 8.7x a year ago. For the listener, what does that move from 8.7 to 7.1 actually mean in practical terms?
It means they're building a bigger equity cushion against losses. The business is just fundamentally safer, and it moves them closer to their long-term goal of 6x leverage. But maybe more importantly, they're getting better terms on their debt.
Right, they had those big ABS deals.
Exactly. They executed flawlessly, over $900 million in asset-backed securities deals. These are basically bonds backed by their loans.
And they were successful. They got AAA-rated senior tranches priced between, 5.3 and 5.8%?
Which is very favorable, and that execution success helped them lower their overall cost of capital from 8.6% down to 8.1% sequentially. They also got more warehouse financing and tightened the spread they pay over the benchmark rate. I mean, long story short, they are demonstrably getting cheaper debt, which feeds right back into profits.
So, with all of this good news, a 50% EPS beat, 20% ROE, cheaper funding, we have to talk about the elephant in the room.
Yeah.
The divergence. The stock had pulled back, like double digits in the months before this call. Why all the skepticism?
The market is basically in show me, don't tell me mode. The skepticism comes directly from the macro headwinds facing the consumer. Even though Oportun's 30-day delinquency rate improved year over year, management was very quick to admit that it was still at the high end of their internal expectations for the quarter.
And that's the caution we're seeing everywhere, right? The consumer pressure, inflation hitting lower income folks. So what was their immediate response to that pressure point?
Immediate credit tightening. They started using a new early default model, and they cut average loan sizes. Unsecured loans are down 5% year over year. Secured are down 7%. They're proactively pulling back on risk to keep loans affordable for their customers.
And this tightening led to a slight but very important change in their forward guidance. They raised the full-year adjusted EPS guidance, but they also nudged up the full-year NCO guidance just a little bit.
Yeah, just by 20 basis points to a 12.1% midpoint. And management was very transparent here. They expect this higher net charge-off rate, the loans they don't expect to collect, to have a temporary peak in Q4 and Q1 of next year.
So the critical catalyst for investors is what happens after that.
Precisely. The expectation is that losses will ease meaningfully by Q2 2026 as these tightening actions and that back book finally rolling off take full effect.
And that skepticism is why the street's average target price is still way up around $8.67, a huge gap from where it's trading now, near $5.21 post-call. The market is just waiting for them to hit that Q2 2026 target.
Which brings us, I think, to our final segment.
This is not financial advice segment, trade ideas.
And we need to be absolutely crystal clear on this. This is purely an analysis of the trade landscape based on the call. We are not offering investment advice.
Right. With that said, the pitch thesis here is pretty straightforward. The market is valuing this stock based on its old problems, the historical volatility and legacy credit risk. It's effectively ignoring the structural de-risking we just talked about.
4 straight profitable quarters, a 20% adjusted ROE, successful capital execution.
All of it.
So the trade then is a bet that these structural improvements are going to override the short-term credit noise. It's a bet on the price reverting to something closer to fair value. You'd be looking at, say, a medium-term long position, maybe targeting a Q3 2026 expiration to align with that NCO stabilization timeline.
And the key is that the price is so volatile right now because of the uncertainty. You could actually structure a trade that uses that high volatility to your advantage. To finance your downside protection, you're effectively positioning a slightly leveraged bet on management's ability to just keep executing.
And the core catalyst is simple. If they hit that Q2 2026 NCO stabilization target, that will be the de-risking event that helps close the massive gap between the current price and Wall Street's target. It's a bet on them continuing the operational discipline we saw this quarter.
So to recap the highlights of this deep dive, Oportun delivered its 4th consecutive GAAP-profitable quarter, a massive 20% adjusted ROE print. And we saw that tangible shift towards secured loans for better quality growth.
And a significantly improved funding profile with a lower cost of debt and less leverage on the balance sheet.
Which brings us to a final provocative thought for you to think about. The governance here has been stabilized through 2028, thanks to an agreement with the activist investor Findell Capital. So given that stability and the current trajectory toward their 6x debt-to-equity target, what new strategic flexibility or capital allocation options, whether that's M&A, capital returns, or even faster portfolio growth, what does hitting that crucial 6x leverage ratio actually unlock for Oportun in 2026?
Something to mull over as they finally exit this cleanup phase.
Thanks for joining us for this deep dive.